Good day and welcome to Shree Cement Limited Q2 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Before we begin, a brief disclaimer. This conference call may contain certain forward-looking statements about the company which are based on the beliefs, opinions, and the expectations of the company as on the date of this call. The statements are not the guarantees of the future performance and involve risks and uncertainties that are difficult to predict. I now hand over the conference to Mr. Naveen Sahadev from ICICI Securities. Thank you and over to you.
Thank you, Mark. Good evening, everyone. On behalf of ICICI Securities, I welcome you all to the Q2 FY26 earnings call of Shree Cement Limited. From the management, we have with us Mr. Neeraj Akhoury, Managing Director, Mr. Ashok Bhandari, Senior Advisor, and Mr. Subhash Jaju, the company CFO. So without any further ado, I hand over the call to the management for opening comments. Over to you, sir.
Q2 of FY26. As you all know, last quarter the Government of India took a significant decision of reducing the GST rate on cement from 28% to 18%, along with various other commodities. We believe this was a very positive and a transformational step and augurs well for cement demand in the long term. The company has fully passed the benefit of GST rate rationalization to its customers. The company continued with its value over volume strategy during the last quarter. The total cement sales volume, including that of Shree Cement East Private Limited, were up by about 6.8% YOY on cement basis. With cement and clinker combined, it was slightly lower. Total sales volume increased from 7.6 million tons in September 24 to 7.9 million tons last quarter. Realization per ton increased from rupees 4451 per ton to rupees 4840, mainly due to increase in share of premium products from 15% last year to 21% in September 25 quarter. Total EBITDA accordingly increased by 46% from rupees 582 crores to 851 crores. EBITDA per ton, and this is a figure adjusted for rupees 30 per ton for one-time impact, also increased sharply by 43% from rupees 772 to rupees 1105. On sequential basis, volumes were down by about 12%, mainly due to heavy rains in North India in the monsoon season. Despite this, the company was able to maintain its realization. However, the total EBITDA at rupees 851 crores was down by about 31%. EBITDA per ton also decreased by 20% from 1379 to rupees 1105. Very happy to say that the company's UAE operation registered its best ever quarterly performance. Sales were up from 9.87 lakh tons to about 13.1 lakh tons, growth of about 34%. Sales revenue also registered growth of 50% YOY, and EBITDA increased by 158% from AED 20.34 million to AED 52.53 million. The improved performance is a result of increased realization and improved operational efficiency. The expansion of the unit is progressing well. During last quarter, the company commissioned clinkerization unit of 3.65 million tons at Jaitaran, Rajasthan. The cement mill of 3 million tons is also expected to be commissioned very shortly. The work on integrated project at Kodla, Karnataka of 3 million tons is in the final stage of completion and expected to be commissioned in this quarter. The company is continuously exploring various opportunities to grow better than the industry growth, or slightly better than industry growth. Recently, the company has also commissioned a 20 megawatt solar power plant in Chitrakoot, UP, in one of its subsidiaries. With this, the total green power capacity of the group now stands at 612 megawatts. The company has been rapidly expanding its RMC portfolio with 24 operational RMC plants at present. During the quarter, the company entered East India market by setting up its RMC plant in Raipur, Chhattisgarh. The company also commissioned India's first RMC solar plant as a Jaipur facility. The unit now runs primarily on green, clean, renewable solar energy, reducing its carbon footprint and setting up a new standard of eco-friendly construction in India. We are very proud to say that the share of green electricity in total electricity consumption stood at 63% in H1 FY26, which is the highest to my mind globally, but at least highest in the Indian cement industry. All the company's manufacturing locations are also zero liquid discharge, treating, recycling, and reusing 100% of its waste generated from its operations. These efforts have enabled the company to improve its water positivity index to more than 8 times. With good monsoons this year, the company expects to further improve its water positivity levels. India's economy continues to demonstrate resilience underpinned by strong consumption and sustained investment activity. High-frequency indicators point out to a pickup in real GDP growth in the second half of this year, supported by above-normal monsoons. Steady employment conditions, benign inflation, and recent rationalization of GST rates are further expected to stimulate demand. These factors are likely to accelerate infrastructure development and growth of housing sector, which bodes well for the cement demand. With this, I have with me Mr. Ashok Bhandari, Mr. Subhash Jaju, Mr. KK Jain, and Mr. SS Khandelwal to take you through the Q&A session. Thank you very much, everybody.
Naveen Bhandari here.
Yeah,
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi, good evening. Thanks for the opportunity. So, on cement realization, you mentioned it was 4,840 per ton. This excludes other operating income, if I'm not wrong, and could you give a similar number for Q1 as well? I think we could host a call last time.
4840 is excluding other operating income. The previous quarter I had explained that because of a glitch in our SAP system, we could not come up with an NCR number. The NCR number this quarter onwards will always be disclosed to everybody. That glitch has been rectified. So we do not have a comparable Q1 number, but roughly there is a decline. There is a decline. Q on Q increase you have already understood. Mr. Akhoury has already addressed it, and I will request Mr. Akhoury to address the second part of the question. Sir, that was on EBITDA volume pe or EBITDA.
So I'm just trying to understand your question. So what we have said that the realization per ton this last quarter was 4,840, yeah, which is increased from 4,451 in same quarter last year.
Sure. And you also mentioned they continue to prioritize realization over volume. Given that we are in the midst of a significant expansion program, what would be then the outlook on the expanded capacities? Can we expect them to kind of have a slow and gradual ramp up? What would be the outlook on the volumes essentially?
Amit, please understand that there is no entry barriers which anyone can create in the cement market. It is your strategy of value over volume which restricts you to your dispatches. However, I can assure you, we'll be growing either in line or slightly better in line than the industry.
Sure. And just lastly on the one-off, you mentioned that adjusted for one-off. What exactly was the one-off?
I am giving it to Mr. Khandelwal, who is company secretary. He will explain you what it is.
For our Guntur unit, we had taken power connection from Andhra Pradesh Transmission Company, and we had to create a substation at our capex, which, as per the agreement entered into with them, was to be transferred by way of a gift deed back to the transmission company. This transaction took place this quarter, and therefore this write-off.
Understood. Sure. Thanks a lot. I'll come back in the queue.
Thank you. The next question is from the line of Rahul Gupta from Morgan Stanley. Please go ahead.
Yeah, hi. Thank you for taking my question. So, just to delve a little deeper into, is there any other one-off in other OPEX? I see there is a strong jump year on year on the other OPEX side. So, any explanation on that would be great. Thank you.
I'm giving the line to Mr. K.K. Jain. He will explain you what it is.
Yeah, good evening. As such, there is no other one-off in the result. The expense is current quarter expense is slightly higher because of the repair maintenance cost and other stresses cost. Otherwise, there is no one-off in this.
Great. My second question is for Mr. Akhoury. Now that we are getting out of monsoon season, how should one expect demand from here on over the next couple of quarters? And are we seeing any green shoots from GST cut with respect to retail/rural demand picking up? Thank you.
So, little too early to project demand this moment. As you know, we're just coming out of festival seasons. As we speak, actually today is Chhath, and happy Chhath everybody. But this Chhath also means that there will be significant labor shortage across construction sites in most of our markets. Let us see how demand pans out. We expect, and as everyone, that GST cut would boost demand in the long term. We have to wait and watch of its impact in the short to medium term. But clearly, GST cut was, as I said earlier, it was a transformational step, and this augurs well with the cement industry demand projections.
I would like to add, Mr. Gupta, that the effect of GST payable on finished houses hurts the low and middle income houses more. So the vibrancy in low and middle income houses, as well as tier 1 and tier 2 cities, is expected to be far better than what it had been.
No, understood, sir. So my question pertained mainly from the perspective of how should we see the balance between demand and cement pricing over the next few months. So that's what I was looking for.
No, I fully understand your question. As I said, we have to wait and watch to see how the demand pans out. Little too early to say. Given the fact that there has been a GST cut, one would argue that the demand boost should happen. But it may take some more time before actually it is converted into purchase. And that's where I'm saying in long term, it is good for the industry. It is good for everyone that there has been GST cut. We have to wait and watch for its immediately what will happen, or in the short term what will happen. Prices, as I speak for Shree Cement, we have passed on the entire benefits to the consumers of the GST reduction. If you see our results, I think one thing you will notice is that our prices have remained almost similar to last year, same quarter, the last quarter, not say this year, last quarter, and about 20% growth, 19% growth from last year. Yeah, I think prices have been stable for us from this year last quarter to the last quarter one to quarter two. Going forward, it is not for me to forecast prices. It will be wrong. But what I do see that if the demand grows little better than what we have seen in the first 6 months, then prices should at least remain stable, if nothing else. Yeah.
Got it. Thank you so much, and all the best.
9%.
9%. I am so sorry, I must repeat myself. Year-on-year price growth was 9%, not 19%. I'm so sorry.
Thank you. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, good evening. Thank you. Just wanted to ask on overall volume and the capacity that you're looking at, especially in North, now that you have new volumes from the new line. Just wanted to see how are you going to look at this volume versus value growth. For the last few quarters, the focus has been on premiumization. Should we expect similar focus in new capacity that you have? That's first, and maybe tied to this would be the second question, that other players are also looking aggressively at North in general. Typically, if I look at your capacity, it seems incrementally you're also looking at North, but also expanding out of North. And North is typically 50% of overall capacity. As you look beyond the expansion, and in the release you mentioned 80 million ton, how would you look at expansions across region? With new capacities coming in North, would you look to maintain share and add more capacity in North, or just the thought process on incremental capacity beyond what you have in mind?
So to answer the first part, as I said in my opening remark, that on premium cement we grew from about 15% to about 21% this year. This has been possible with a very high focus on increasing our share in the premium product segment. Not only that, we have also worked on our general price levels and to make sure that we are able to squeeze our brand equity in a better way. That has been the strategy which we have often defined as value over volume, and this strategy is something that we would like to pursue in the coming years as well. On capacity, we have just commissioned, as I said, a new kiln in our North plant, and this quarter itself, very soon, you will see us also announcing the cement expansion in the same cement mill commissioning in the same location, which should happen very shortly. North remains our focus, and North is something that will remain our one of the areas where we will continue to evaluate all possible methods to grow in the coming years as well. Having said that, we are growing in other regions, be it East, be it South, and that will be on. But our focus on North will never go down, is what I would assure everybody.
I have two more things to add. One is that if you look at the standalone and consolidated results, the EPS differential, which was always around 6-7 rupees, has gone up to 33 rupees in favor of consolidated, which clearly points out that our UAE operations are doing far better. Mr. Akhoury had already pointed this out in his opening statement. And we are expanding our capacity there, as there has been very a healthy price rise in UAE market. Also, you will note that we generally have been very conservative in our dividend payout, but this year we have given highest interim dividend of 80 rupees, and we expect to have a incremental dividend payout, but then there are various factors affecting this. Everybody had questioned us on the rationale of carrying such cash large reserves. So, and some chief investment officers had asked for higher dividend payout, and we have acceded to that.
Just one clarification question on both dividend and depreciation. So, generally, depreciation has been very volatile. Why is that volatility?
This year we will be depreciating about 2,800 crore or so, which is based on the capitalization schedule. We have already charged about 1,100 crore in 2 quarters. So the depreciation for next 2 quarters will be about 1,700 crores. And that's all right, because as everybody is expecting, so we are, that the prices should remain stable and the demand should return. So there will be no hassle in availability of distributable profit in any case for the year.
Okay. Thank you and wish you all the best.
Thank you. The next question is from the line of Pinakin.
Excuse me, 1 second. I stand corrected. The depreciation for the year will be 2,450 crore, not 2,850 crore. I'm sorry.
Thank you. The next question is from the line of Pinakin from HSBC. Please go ahead.
Yeah, thank you very much. So for my first question is that among your 3 core markets of North, South and East, how is pricing today on the ground versus the second quarter average? Is it lower or is it flat?
Are you talking about the last quarter?
No, sir. Today, yes. Today's prices versus the second quarter, the September quarter that went by.
No. So as I said, that the prices have been reduced, but that is only because we have passed on the GST to the consumers. Yeah. To that from 28 to 18. So the prices are lower than what it were in the pre-22nd September time.
So the net realizations to the company would broadly be unchanged today versus what you have seen in the second quarter.
No, I would say it will be slightly lower because of all the festivals and all. The demand has not been very robust in October, and therefore we see some slippage of prices happening across India, not only in regions. Yeah.
Got it. So my second question is that, again, if you were to look at your 3 core markets and over the next 2 quarters, do you see any one region demand outlook to be materially better than the other between North, South and East?
I would, again, as when you talk about demand forecast, I always keep quiet because we have to be cautious in this statement. As we speak, we have seen demand growth almost similar across the country. Yeah, almost similar, except some states where it has been lower and some states has been higher. Not to compare region-wise, but maybe state-wise, one can do some comparisons. Going forward, also, I think this trend should continue. Only I would expect North and West to be slightly better than rest of the country.
Got it, sir. And so my last question is, again, if you look at your competitors' capacity expansion announcement, particularly in Northern India, which is very large, and you highlighted that North is a core market for Shree, should we expect Shree to defend its capacity share and hence allow some point of time announce capacity expansion to maintain its current share?
This is a trick question, isn't it? This is a trick question. We have said that we will be growing marginally better than the industry. Now, which region, what kind of growth? How do you all forecast this? We have to be prepared. We are having sufficient physical resources to set up capacity in most of the areas where we operate, and we'll take a call as the demand scenario becomes more clearer.
Understood. Thank you very much, sir.
क्या कट गया क्या? Is the moderator there, please?
Hello.
Yeah, can you hear me, sir?
Yeah, that's fine.
No, I think we've lost Mark. I can't hear him. I'll just dial him back. 1 second.
The next question comes from the line of Kunal Shah from DAM Capital. Please go ahead.
Now, since the time we have undertaken the measures to improve the brand positioning and the premium sales, on a portfolio level, how much would have the base realization improved on a per ton basis? And what would be the milestone here along with any timelines if you can help?
When we look for the numbers, the milestone remains that we have already reached about 20-21% of premium sales. This is the level at which we would like to maintain in the coming quarters as well. Yeah, if there are some improvements, that will be welcome, but milestone was to reach about 18%. We have already reached 21%, up from 15%. And we will be focusing a lot that we are able to maintain this same level of premium share of our trade volumes in the coming quarters as well. Yeah. Can you answer the first question?
Kunal Bhandari here.
Yes, sir.
Can you repeat the second part of the question?
First question.
No, sir. So one was the premium sales, which is very clearly visible, but also there have been, steps to improve the brand positioning as well, right? The base brand positioning. So all I'm trying to understand is, since the time you have taken these measures, how much would the base realization moved up? Let's say keeping other things aside, status quo, how much would have the base realization improved?
Kunal, that is the point I'm trying to make. Mr. Okhuri in his opening statement had said we have improved 9% year on year. It is unfortunate that I could not give you a NCR number for Q1, but Q2 or H2, H1 vis-a-vis last year H1, 9% incremental price is there, which is a mix of various things. And it is, you see, please understand, my dear friend, that if we are saying that we will focus and we have reached 21% of premium sales, then the price trajectory should be upwards or stable. But then demand and pricing in commodity, it is very difficult for any company to address, isn't it?
Understood. No, that helps. And secondly, sir, on the cost savings, especially on the logistics front, now where exactly are we in the journey? And, because we were planning to aggressively increase the rail share. So could you just reiterate, our positioning here and the quantum of...
So, just to reiterate on our last question once more, before I come to the second question, this question. So, as I said, we have increased by 9.8%. I believe some of the players who have announced the realization YOY, if you see the gap of our performance versus peers, you can get a sense of how much we have improved. That is part number one. On the rail, very focused work is going on. We have, as you know, already commissioned our Purulia railway siding in our Purulia unit. We are doing siding in Kodla, for which the project work, land acquisition has been done, and now the construction process has started. Similarly, for Ida, we have completed the land acquisition and project work has started. So a lot of focus has been there to improve our rail connectivity across India, and you'll see that very soon. Some of them will be commissioned. Yeah.
So this is very helpful, sir. To extend it, like in F25, what would be the rail mix exactly? What are we going towards, and what would be the savings? If that would be very helpful.
So presently we are at about 11%, of rail share in our total outbound logistics, and we think we should reach about 20% in the coming time. If I see at savings, typically on the PTPK rail is about 1.8, 1.9. Versus road at about 2.3, 2.5. If I look at the industry across, especially in the north region. So one would expect that at least 100 crores, 100 rupees per ton savings should come from our increased focus on railway operations.
Got it. And sir, if I could just squeeze in one more, I think there was a lot of efforts towards the AFR share as well, right? So 100 rupees on the logistics front, and anything on the AFR front, because I believe that share is also on the lower side, right? I mean, there's a lot of scope over there.
Yeah. So as I said, a lot of project work is happening across on the AFR side as well. We are now at about 2.3%, up from 1.5% same quarter last year. This is on FR usage, and more and more facilities are getting created. As they roll out in the coming years, you will see we will also go up on our AFR consumption.
Got it. And sir, if I could just squeeze one more, just from a capital allocation perspective, what should be the capex number for 26, 27, and 28?
26, 27, roughly you estimate 3,000 CR. And 27, 28, we have not. We have a broad capex in mind, but it should be in line with this much only. It may spill slightly to 28, 29 because we are rethinking our commissioning strategy. But I can assure you that we will maintain our spirit of growing marginally higher than the industry growth rate.
Just to clarify, so 80 million ton could get spilled over to 29, you mean?
I cannot, you see, please understand, it's not that we are devoid of any physical resource. It is basically how the capacity utilization of the company gets ramped up and how the demand gets ramped up. So it is dependent on that. We are taking a stand that if needs be, 80 can shift to 80 by 28 may shift to 80 by 29. But then as the time passes, we'll keep on updating you.
Understood. This is extremely helpful, sir. Thank you so much and all the best.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital.
Hi, sir. Sir, just to check, so now currently we have a 62.8 million ton and 6 million ton both Jatron and Kodla will be added in this quarter, so we will be 68.8. And from there, by FY27 and 28, will there be any capacity addition because 3 million ton Jetran was postponed now?
Wait a minute. You are asking too many questions. Let us address one at a time. 67 million, 66.8 or 67 million, March 26 is given. We have given you a CAPEX guidance of about 6,000 CR, so we should be about 72 to 75 million March 27. I have already told you that let us see how the demand and how capacity utilization moves to see whether we need to become 80 by 28 or 29. You have seen our balance sheet. You understand we have all physical and financial resources to do this CAPEX. But that market also has to, the market conditions are to be recognized in planning exact dates. So
yeah,
go ahead.
Got it, sir. And then this 2028 or 2029, when we say, is this a calendar year or FY28 or FY29?
No, FY. We are not talking calendar year at all. We talk FY.
Okay. Got it. Sir, I need a couple of data points. So even last quarter we did not have a call. So if you can share the data points for Q1 and Q2. So starting with first is trade share.
One second, Dollar. One second, Mr. Dollar Capital. Let Mr. Subhash Jaju take you through all the numbers because he is the CFO of the company.
Yeah.
You can ask all your questions and pointed questions to him.
Yeah, sir, trade share, blended cement share for Q1 and Q2.
Yeah, so for trade sale, it was 70% in September 25, and in June it was around 71%. Blended cement sale was 68% in September and 70% in June.
Okay, and lead distance in Q2 and Q1?
In Q2 it is 441 kilometers and Q1 it was 451 kilometers.
51 kilometers. Okay, got it. And KKL for Q2 and Q1?
For Q2 it is 1.66 and Q1 it is 1.59.
1.59. Okay. So it has decently gone up from March level. So given the current whatever the petcoke prices and the coal prices, do we see any further increase in this KKL cost?
No, as per our inventory pipeline, I think it should be around similar levels, maybe slightly lower than this.
Okay. And in terms of the fuel mix, broadly the petcoke and coal would be a 90-odd%, 95%.
No. This quarter it is like around 66% it is petcoke and balance is coal and other alternate materials.
Okay, got it. And
sorry to interrupt.
Yeah, no issues. I will be. Thank you. Yeah.
Ladies and gentlemen, to ensure the management can address questions from all participants, please limit your inquiries to 2 per person. If you have a follow-up, kindly rejoin the queue. The next question is from the line of Rashi from Citi. Please go ahead.
Thank you. My first question is, Mr. Khuri, you made a comment saying that, in addition to premiumization, you're also focusing on pricing to be able to extract the best value for your brand. Could you just elaborate on that, please?
Well, look, Rashi, let us understand. Only 21% is premium now. In our sales mix, Mr. Khuri has clearly said only 21%. But if you look at the incremental price rises, it must be incremental plus general category also. You get my point. So overall there is a price buoyancy. Now how it will pan out is completely dependent on market conditions. But the delta between peer groups, we are certainly trying to converge on the top line, rather price.
Right. So how are you trying to do that?
Mr. Khori will answer that, please.
No, so in a sense, this market, as you know, the industry market, there are for same kind of product there is a price ladder which is not less than 15 to 20 rupees or even higher, and this is what we call the price gap between brand A and brand B. Through our pricing actions as well as distribution actions, we are trying to reduce this gap, and that is one effort that has worked for us in the last 6 months odd, and that is where we said that we will focus on value over volume. In addition to that, we have also focused on premium products which are higher priced than the base product, and they have their positioning in the market is on the higher side, and so these two combined. So for base brands as well as for premium, there has been a focus of reducing the gap with some of the peer group companies. That has helped us to record 9% price growth last quarter. Versus I am not so sure I have seen the figures of others, but whatever figures others have, if you could look at it, then I think Shree's performance on price growth will be slightly better than what industry has seen.
Understood. Thank you. That's helpful. Then on the volume side, for the first half, now your volumes are down about 2% on a year-on-year basis, total volume, cement plus clinker. So what is your projection for the year for yourself?
We should do about 37 to 38 million tons this year.
Yeah. Okay, I'm maintaining that. And on the power side, so green power, I would imagine that in this quarter, your green power proportion has gone down to about 60-odd% or so?
Yes.
I mean, for the first half,
it's 60%, yeah. 63%.
So what is it for the quarter?
Rashi, you are forgetting. Renewable also consists of solar, and this was monsoon period.
Okay. So but 60 is the correct number, right?
Yes. Yeah, 60 for the quarter is the correct number.
Okay, got it. Okay. That's it from me. Thank you.
Hello. Thank you. The next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, good evening, sir. My first question is on your UAE plans. Can you elaborate on what the expansion plans there and overall outlook? As you said, is like very positive.
So, the UAE demand has been quite robust, quite healthy in the last 1 year, if not a little more than that. Yeah, we are at our assets in UAE are very well positioned to serve all parts of the country, including the main consumption centers of Dubai and Ras Al Khaimah. Our numbers have shown that we are doing very well, and hence we have decided to put a new mill there of the 3 million ton capacity. We have extra clinker, so in UAE we used to sell clinker earlier. We now believe since the cement demand is very robust, we can convert that clinker into cement and sell it in the domestic market. In addition, in UAE, we also produce some special cement products like oil well cement. And oil well cement from our facilities goes across the world, not only in Middle East, but also in some markets of Europe and some markets of US, North America. We are also doing a debottlenecking of our kiln there. That will give us about 500,000 ton of additional production of clinker. So overall, we are very positive on UAE market and as well as the Middle East market where we sell. not only the base product but also the special products like slag and oil cement, and hence this capacity expansion program has been announced.
And what is the full quantum of capex if you're looking at? It probably is part of consolidated operations and not standalone capex.
110 million AED.
110 million AED or approximately of capex in UAE.
By the way, I must point out that it is fully funded by UAE, by cash available at UAE.
Yeah, it is fully funded by
cash available
at UAE. Yeah.
मैं तो फिर से बोलेगा 250 करोड़.
Thank you. And other question is on this 40 EBITDA per ton of 1100, then with very minimal visibility on price improvement in third quarter, how are we looking at our EBITDA per ton profile of 1300 to 1400, which we used to sort of discuss earlier?
Pratik, this question you ask me every quarter, and every quarter I humbly suggest that it is impossible for the hands of any commodity supplier or manufacturer to predict the price. Price is not in our control, my dear friend. Market forces decide the price. So when will my EBITDA go up at 1300 or 1400? I'm not in a position to answer, Pratik. Please appreciate that. Any incremental price rise is a straight flow to my bottom line. Now, how much incremental price rise will come, when it will come, how much volume will come, these are affected by various macro factors. What is, you are looking at 1300 rupees, why not 1800? Let us understand, let us be realistic. We have said we have done 1100. Mr. Khoury has clearly said that he does not expect, he expects some demand vibrancy, he expects a stable pricing scenario. So at worst we will do 1100, at best we can do 1200. I don't know that. I am not saying everything. Maybe we can do 1300 as well. But you will have to have patience, my dear friend. People have been claiming all kind of EBITDA never delivered. We don't promise anything. We deliver and then we say.
Certainly, sir. Thank you. This is my question.
Yeah.
Thank you. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi. Thank you. Just a couple of questions. First, on the dividend, we appreciate just the thought process that there is spare cash and some of it can be given out as dividend. But still, if you look at dividend yield, it's still, even after dividend, interim dividend, looks like 0.4% odd. What is...
yeah, go ahead, please.
What is the need for having such a lot of dry powder still on the balance sheet, given the capex and all you're looking at for the next 2-3 years? Why not look at one-time dividend, special dividend? Just the thought process on keeping so much spare cash on the balance sheet.
My dear friend, on our strategy of keeping spare cash, please talk within your firm with Nitin Bhasin. We have explained to him many a times why this cash is needed. And the other point that why not one time, तो ये तो दिल मांगे मोर वाली स्टोरी हो गई भाई. बढ़ा के दे रहे हैं, बढ़ाते रहेंगे, पर एक टाइम में ही क्यों नहीं दे देते? अरे भाई ठीक है, समझ लिया, we'll address it.
Second would be on the growth that you're outlining. You're talking about growing in line with the industry, and that I'm guessing will, or maybe slightly higher than industry, that maybe looks at volume growth. So what, and also capacity utilization, what, is there any capacity utilization number that you typically look at?
Is there any demand number you can tell me? Can you tell me what is your expectation of demand growth? And what is the basis of that expectation? तो वो जो होगा उसका ग्रोथ तो हमको भी मिलना है, उससे तो मार्जिनली बेटर भी मिल सकता है. ये तो आप मुझे क्वेश्चन पूछते हो, आप समझो साहब, ये कोई आंसर नहीं दे सकता कि कल कितना सीमेंट बेचूंगा मालूम नहीं, कल क्या भाव में बेचूंगा मालूम नहीं. हाँ, इतना है कि आपको peer group comparison में we will not look shy upon. We will be doing either equal or better. आज तक तो बेटर ही किया है, होपफुली वही मेंटेन करेगा, भगवान साथ दिया तो.
Okay. Thank you.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi, thanks for the opportunity again. So, just again some data questions actually. So, what would have been the other operating income in the quarter, if you can share that?
Other operating income? You have that, yes?
Hello.
Yeah.
Amit, you can send us a mail and then we'll reply on that, because right now that data is not available.
Sure. And also, you mentioned cement growth of 6.8%, but what would be with clinker? If you can give the total volume basically for the quarter.
Yeah, I think you missed the first part of the opening remark where we have given the volume. It is a 7.9. So the total growth will be around 4.8, 4.6, 4.7%.
Around 5%.
Got it.
5% is simple cement and clinker both. 6.8% for cement.
For cement only.
Got it. That's all. Thank you.
Thank you. The next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hi, sir. Good evening. My first question, you mentioned on the premiumization benefit which you have accrued, which I can read in the numbers, given that Q2 you have delivered around 9% NSR growth, while most of the other companies have delivered 5 to 7%. I believe for H1 also you mentioned 9% realization growth. Hello, am I audible?
Can you ask the question again, please?
You mentioned the cement realization, that your like-to-like cement realization growth is 9% for Q2, right? Year on year.
It's 4854 over 4409.
Which comes to around 8.7 or 9%.
9%, yeah.
So for H1 also the growth is similar, around 9%?
For H1 also, yeah, it's similar at about 9%, yes.
Around 9%.
9%, yeah.
Okay. So if I work backward, so your cement realization on a Q-on-Q basis would have come down by around 1.5%.
It is flat actually. It is
flat. Okay, it is flattish. So on the UAE business, you gave the volume numbers for Q2. Could you share the Q1 number also and the YOY number for UAE this year, Q1 and last year? And also a request, can we, now that UAE is also delivering performance in line with the domestic operations, 20 plus margins, can we look at the company at a console level rather than, looking the two units separately?
Indeed, you should. That is what the idea is. That is why I pointedly gave the cash EPS number. So now onwards, maybe a consolidated result for valuation may be more authentic and more than doing standalones.
So Q1, what was the volume number?
You take the numbers from Mr. Akori, he's prepared with the actual volume numbers.
So last year, same quarter, UAE was at 9.87 lakh tons, and this year it has been 13 lakh tons, 13.19 lakh tons.
That is Q2, right?
That is Q2, September 24 versus 25. And
Q1
25 was 10.09.
Sorry, Mr.
So June 25 was 10.09.
Okay.
September 24 was 9.87. And September 25 is 13.19.
Okay. And June 24 also, would you have handy?
No, that I don't have. I'm so sorry.
You can send us a mail. We will reply.
Sure. We'll get in that. Great. Yeah. That's all from my end, sir. Thank you.
Thank you. The next question is from the line of Sumangal from Kotak Securities. Please go ahead.
Yeah, good evening. So first question on the volumes. If you look at 1H, there's a decline of 2%. Just want to understand either industry-wide or in our core markets, what would have been the market industry growth? And just trying to understand what is the market share loss which we've seen.
So I would not have the H1 number for industry, but quarter two, the best estimates coming is around 3 to 5% cement demand growth. Yeah. Versus that 3 to 5%, we have done slightly better at 6.8 on cement sales. Yeah. The first quarter was when we were very firmly trying to establish our value positioning in the market, and therefore you saw lower than expected growth. But second, last quarter, I believe, and the best information that I have of market growth versus 3.5% of industry growth, we are slightly ahead on our performance.
Let me just also make one point very clear to you on our value proposition. Concall numbers of 914 have been reported vis-a-vis our standalone number of 1105. If you compare it with standalone, it is 966 to 1105. So the delta which was there in Q1 of 137 rupees a ton in EBITDA has been slightly bettered, I think, by 2 rupees or something.
Understood. So, sir, should we understand it this way that if you look at even FY25, our volumes of flattish 1Q also, we would have, appears that we would have lost market share, and from 2Q now we are maintaining and gaining. So now, since our value proposition is now established, and even for future when a lot of capacities are coming up and you guided that we will be maintaining share and even gaining to some extent, now there is a subtle change in strategy. Is this the right way to kind of look at?
Oh, wait a minute. We have not said that we will not remain focused on value. We expect additional demand to come in because of all the fiscal measures announced by the Government of India, and that should keep us in line or better than the industry depending on the geographical reach. Number one. Number two, you also please appreciate that the value over volume proposition, you do a very simple calculation. You do the capacity utilization of all cement plants and plot EBITDA per ton of all cement plants. You will see what do we say? The inverse correlation. So have a look at that.
Okay.
So second just to reinforce that there is no change in the strategy. This is what we would like to keep reinforcing. Yeah. So it is value over volume. Having said that, and you have seen that in the results when we say 9% realization growth over last year, and then you should compare it with the industry numbers, and I'm sure you will find that we have not done badly. At the same time, while delivering 9% realization growth, we have also delivered 6.8% volume growth. It only means that the strategy has started working. How does the future pan out is difficult to say at this point of time, and that is how I would say.
Clear, very clear. So on RMC business, looks like there's a lot of focus here. If you can just share what is the outlook and next 3-4 years, what sort of targets are we looking at in terms of number of plants, maybe revenue contribution, etc.?
No, so RMC is a new business for us. We've just started a year back. Already about 24 plants are operational. I think this is one of the fastest ramp-up of RMC business in this industry. We had an initial goal of going up to 40 plants by FY28, and that continues even today. we are trying to put up more plants. 26, I'm so sorry, not 28, 26. Yeah. Having said that, it is also a time for us to better understand the profit levers, the revenue levers for this business, and make it more prepared so that we can have a playbook of RMC business, and we can therefore thereafter keep putting new plants at a better performance level. That is how I would see it. Yeah.
Understood.
Thank you. Ladies and gentlemen, we will take that as the last question for the day. I now hand over the conference over to the management for the closing comments.
Thank you, everybody. Thank you for participating. And thank you for supporting Shree. As I said, we will continue to remain focused on delivering a better performance. Our strategy is working, and we hope we should continue to give you better than industry performance, at least on EBITDA in the coming years as well. This is our focus, and this is how we would like to perform. Thank you very much again, everybody. Happy Diwali.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.